Why listen to John Thomas? Well, I have 53 years of experience in the global financial markets,
John,
10 years running the Economist correspondent office in Tokyo, Japan, and later the White House. 10 years running the international equity division at Morgan Stanley. Brief time out as a Marine Corps combat pilot in Desert Storm. 10 years running the first international dedicated hedge fund. 5 years fracking for natural gas in Texas. 14 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry. Let's see if I can get this to play, that is. There we go. That's my friend's 1929 Travailer D4D biplane, probably the oldest flying biplane in the world. I spent 5 years fracking for natural gas in Texas, 14 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry. Take my half-century of trading experience and add it to your own. Learn from my trading mistakes so you don't have to repeat them. And believe me, there have been plenty. Oh, and if you ever need a ride in a 100-year-old biplane, I'm your man. This is my friend John's biplane, which he lovingly restored, and I'm flying it over the Malibu coast in Southern California. And what do we do when we have free time in a biplane? We buzz the surfers, which I will be doing at the end of this webinar. So my family origins are very humble, growing up as the oldest of 7 children on a remote farm in Southern California. I lived the all-American childhood, playing Little League baseball and becoming an Eagle Scout. Wasn't much to do in rural California in the old days, but hunting. So I picked up a job as a paper boy for the Los Angeles Herald-Examiner. I found the stock pages, bought IBM at 20, sold it at 30, and suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I'd visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions killed. I didn't see a future in that, so the government sent me to Southeast Asia for a few years of research, where I learned how to fly and jump out of perfectly good airplanes. There I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. Ta-da! As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea since the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market, so I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to do things like fly your own plane around Europe, buy the latest hot car, go marlin fishing in Mexico, and collect vintage Rolls Royces for fun and profit. I sold my hedge fund in 2000, retired to go into the oil and gas industry. After making a killing there, I missed the stock market and started the Diary of a Mad Hedge Fund Trader in 2008. I now spend my days pursuing my first love, finding winning trade alerts, but I now do it from my 3 mansions in San Francisco, Lake Tahoe, and Zermatt, Switzerland. And I've quit turning millionaires into billionaires. There's far more satisfaction leveling the playing field for the average guy and teaching them how to trade. And that includes you. If I can take a $50,000 account and turn it into 500,000. That is more job satisfaction than I could ever get anywhere. However, every silver lining has a cloud. This is my 2020 tax return, and it shows I paid 8.2 million in taxes on 20 million in trading income. Yikes. I just thank goodness that I can pay that amount of tax and not have it affect my lifestyle. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. If you see an old plane flying loops over San Francisco or London these days, it's probably me. This is the 1932 Tiger Moth I flew in Cambridge, England. This is the 1947 Chipmunk RAF trainer I flew in London. And this is the famous Boeing Stearman, the basic trainer for the US Air Force from the 1930s onward. The ultimate luxury, of course, is to give to those who need it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans, and am a major donor to Wounded Warriors. When wildfires hit California, I visited the main evacuation centers and handed out $10,000 worth of Target gift cards. So the seminal investment theme of our lifetimes is technology. Since World War II, technology's rocketed from 1% of US stock market capitalization to 27% on its way to 90%. Eventually, all companies will become tech ones or cease to exist. Over 50% of new retail sales have been online in 2020, with one company, Amazon, accounting for half of the growth, and that has recently accelerated. Earnings of tech companies are growing at double the rate of non-tech ones, and profit margins are growing exponentially. The technology sector has been the top performer since the 2009 market bottom and will continue to do so for the rest of this decade. Then COVID-19 came along, and it was a huge accelerator for technology. The pandemic accelerated all pre-existing trends in the economy tenfold, bringing the future forward by a decade and boosting creative destruction at an incredible rate. Money is moving out of non-tech into tech, bricks and mortars into digital, old into new. Technology is a huge beneficiary of all of these. After the worst economy in a century, who gains? Innovation at tech companies has exploded. Many companies are rushing to handle sales increases in the hundreds of percent. Productivity at all other companies is soaring to stay in business. US economies coming out of the other side of the pandemic will be far more efficient and profitable than the old one. Surviving stocks will soar with tech and biotech as the leaders. The next big dip is the one you buy. Here is the NASDAQ chart for the last 3 years, and we've just gone from a 25 times PE multiple to an 18 multiple now, and that's with NASDAQ at higher prices. And that happened because the earnings growth at tech companies has been so tremendous. Expect that to continue. So why has tech gone nowhere for a year? Well, thanks to a coming massive liquidity infusions, tech shares outran earnings growth by a huge margin, leading to huge overvaluations. A year ago, it wasn't uncommon a year ago to find companies with price earnings multiple of infinity because they had very high stock prices and no profits and no earnings. They were trading at multiples of sales, which is always a very bad idea. That means a correction was desperately needed in both time and price. We've just had both, with big caps pulling back 25% and smaller speculative shares down 75% or more. Those with the best earnings outlook, like ad-driven Alphabet and Apple, will lead the breakout. Smaller stocks like Palantir are also bottoming out. All adds up to the best tech entry point since March 2020, and may be the last one this decade. Again, here's the NASDAQ chart for the last 3 years and the activity of our market timing algorithm. We bailed out of tech at the end of last year. We bought it at the pandemic bottom. People got enormous returns, some people 1,000% or more. And then we got out towards the end of last year, and we've actually been selling short some of the lead stocks like Apple, Amazon, Microsoft, and Google ever since. And that has been hugely profitable. We're now out of those shorts. The only positions we have left are in the bond market. But after a bottoming out, I expect NASDAQ to once again go to a new all-time high, probably by the end of this year, possibly as high as 18,000. So get into the following sectors right now. And if you subscribe to the service, I'll even give you the name of a good surfing school in North Africa with a seniors division. Watch out, it's a lot harder than it looks. I think I broke my nose a few hours after we took this picture. Intelligence is now permeating every aspect of modern society, especially the trading of stocks. AI will determine the success or failure of all products and companies from now on. Trade the market without an AI-driven algorithm at your peril. AI tied in with big data now leads almost every major corporate sales and marketing initiative. The AI big data combo will also cure every major human disease over the next decade, creating a $1 trillion a year market for cancer cures alone. Palantir is one of the leaders in the big data space. We bailed out of there last year at around 27 bucks, and it's gotten all the way down to $10. So looking like a strong buy. We're targeting 100 for the long term by Palantir. Another way to play this is with the BOTS ETF. That's the Globalx, Robotics, and Artificial Intelligence ETF. That is a basket of the top 20 artificial intelligence and robotics stock. That was a huge performer off the pandemic low, got a lot of people into it, went from 15 to 40, and then it collapsed. We're now all the way back down to 26 again, giving up nearly half its gains. We're targeting $50 by the end of this year. Cloud-based applications. All major companies are now shifting to cloud-based strategies. Exponential growth of data means physical on-site storage is becoming impossible. There is no place for it to go but the cloud, where capacity is unlimited. Massive cloud growth is creating enormous demand for new internet infrastructure. Cloud-based services providers are one of the fastest growth company technology providers. The problem is security. How safe is it? And of course, the plays here are Salesforce, Microsoft, and Amazon. Here's the chart for Salesforce. Just dropped by nearly half from 320 all the way down to 180. We're targeting $200 a share by the end of the year. And you can see how we participated originally going from 120 all the way up to 320, and we're now back down to the 200 level. So by Salesforce. Cybersecurity, as the global economy moves online, so will theft of its most valuable properties. Cybersecurity is an arms race with the stakes rising daily. It's a great setup for investors with a small number of providers facing exponential growth of demand. Most large companies use all of the big three to cover their bases and mitigate risk. Hacking is one of the few recession-proof industries in tech. And then we have 4 ticker symbols there: the Hack ETF, Palo Alto Networks, CyberArk, and Okta. Palo Alto Networks been a huge winner for us. We bought it below 100 in the pandemic low, just hit 600 last week on the threats of Russian cyber attacks on the United States. We're targeting $800 later this year. Autonomous driving. The military has been the early spender on autonomous driving and will get a ton of new money for R&D. Point-to-point self-driving Tesla is only a year away, and the hardware is already being installed on new models now. Current applications are only good on freeways and for parking, and the full point-to-point is an $8,000 upgrade for each car. Tesla's already sold 2 million cars, so you can do the math. 8,000 times 2 million sounds like a lot to me. Tesla, Google, Uber, and Apple are striving for the lead. Worker productivity will soar. Accident rate goes to zero, crushing insurance companies and hospitals. Who will become the low-cost volume producer? Right now, it's Tesla. Google is another play here. They have 92% of online advertising. It's a monopoly with a huge moat and virtually no competitors. Ads are the high beta play in an economic recovery. Advertising is the first canceled and the first restored. We're looking to buy the next dip on Alphabet. We're targeting 4,000 by the end of the year. Online commerce, of course, Amazon is taking over the world with 50% of all new online sales, and COVID has given it a turbocharger because people didn't want to go into bricks and mortar stores. The only other Amazon, like Alibaba, could challenge it, but right now Chinese stocks are in the penalty box as China plays with the idea of abandoning capitalism. Antitrust or other government invention won't challenge it anytime soon. If it does, the value will double. Amazon's Web Services is the 800-pound gorilla you can't see. New business lines beckon like drugs, healthcare, and entertainment. Amazon is going to split this summer in July. That'll take the price down by 1/20th of its current. It'll be in the mid-hundreds when it does that. But on the old price basis, we're targeting $4,000 a share by the end of the year. However, Amazon is likely to break itself up anyway because it'll bring them $1 trillion in free money. Just a matter of time before Amazon becomes too big to manage. It's what the second headquarters search was all about. Retail businesses grow from 600 billion to 2 trillion. Amazon Web Services goes from 400 billion to a trillion. Advertising goes from 10 billion to 100 billion. Other businesses like food, healthcare, and so on go from 0 to 300 billion. That gives you a $4 trillion company by 2023. Then it breaks itself off and sells off each entity separately for a total value of 60 trillion or a 50% premium. So don't worry about antitrust. Amazon is just a middleman for 70% of all their sales, and there is no vertical integration, which is the usual benchmark for pursuing antitrust cases. Internet infrastructure will be big, building the hardware that makes tech work. The new stimulus bill created massive breaks for new infrastructure investment. Any progress in a single tech subsector increases demand for all the others. This creates an exponential growth curve for the entire tech industry, which is how it has come to account for such a large part of the US economy so quickly. Tech is growing so fast that it is creating a jump in demand for semi-skilled blue collar and other support jobs as server farms and high-speed transmission towers cover the country. You no longer need a PhD from MIT to get a tech job, and the plays here are Cisco, Intel, and Skyworks. Here's Cisco's system. It's been kind of flatlining for the last 6 months. We had a buy in there at 35. It went up to 63. It's now selling off. We're looking to buy around this level, and our target is $80 a share. Big data applications are crucial. The mining of massive databases is now possible for the first time by government and private industry. Understanding how to access and manipulate this data is the key to understanding the future of marketing, scientific research, the weather, and even politics. IBM's Watson can read all the scientific papers on cancer in 8 minutes, enabling unprecedented levels of cross-referencing, and we're now in the 3rd generation of Watson. Big data needs new software applications to enhance understanding of and massive server farms to house the data. And the plays there are Google, Facebook, Microsoft, and Amazon. Microsoft was one of our favorites. Last year, it went up almost every day. We then went short at the beginning of the year, made some nice money on that, on a 20% sell-off. We're now neutral and looking to buy on a dip. Our target for Microsoft by the end of the year is $400 a share. Fifth generation wireless technology, or 5G, is a really big deal right now. Big telecom like AT&T and Verizon are investing $30 billion to assure 5G wireless rolls out seamlessly. Increasing wireless broadband capability will increase performance of many products and services by tenfold. It'll bring a new generation of super fast smartphones and other wireless products. Apple brought out its 5G phone in October 2020. Suddenly, many experimental technologies like autonomous driving and AI will become functional and cheap. Download a 2-hour movie on your smartphone in 10 seconds. Yes, you can do that with the new iPhone. And the plays here are Verizon, Xilinx, and Ciena. Here's the chart for Ciena. Had a massive sell-off from 79 to 54. It's rallying now. We're targeting $100 by the end of the year. Microprocessors and GPUs are also a major play. It takes advantage of the worsening global chip shortage, which has been made worse again by the Ukraine war. Look for enormous moves up on the rollout of 5G, creating an acute global chip shortage as chip demand increases 10 times. In a highly cyclical industry, chip producers now facing unprecedented shortage for their products. This is enabling companies to increase margins in a rising market. The barriers to new entrants are extremely high at $2 billion a factory and 2 years to build. Graphic processor units, or GPUs, have been leading the charge into AI. The industry is consolidating at a tremendous pace, further increasing pricing power. And of course, the no-brainer here is my old favorite, Nvidia. We recommended this at a split-adjusted $12 in 2016. It went up to $350. That makes it a 30-bagger for us. And it still looks great because of the global chip supply. So we see Nvidia reaching $500 by the end of this year. This is probably the best company in the world to own right now. FinTech will be another emerging technology. It's turning legacy banking into the next buggy whip industry. Huge, expensive brick and mortar branch networks make it impossible for banks to compete with overhead light FinTech companies. Blockchain is creating encryption for transaction security on an industrial scale. Regulation-like companies have the unfair advantage you are looking for. Paper money carries COVID-19. How about that? So many stores have banned cash payments. Here's Square, one of the leading FinTech companies, just dropped by 2/3 from 300 down to 100. Actually got down to 80 last week. So yeah, screaming buy around this neighborhood. You can see we bought it back here down at 35, rode it up to 300, got a 10-bagger out of it. And now we have another fantastic entry point right here. Smartphones and their apps. Apple will see monster sales with their new Generation 5 phone. 1 billion iPhones need to be replaced globally to take advantage of 5G. Smartphones are a global market with plenty of room for growth. China and India will be the next big buyers of smartphones, and a new pro-trade administration will be a big help. However, the largest player, Samsung, still only has a 7% market share. Apple dominates with 92% of all industry profits, with only a 5% market share, which is luring customers up the value chain. And of course, Apple and Skyworks are the play here. Here's Skyworks Solution, just sold off from 200 down to 110. We're targeting 200 again by the end of the year by Skyworks. Blockchain technology, while all the media focuses on cryptocurrencies, the real groundbreaker here is blockchain. Blockchain could eventually replace the entire banking system, could also spawn a global currency run by governments. It will be those who sell the shovels to the miners who make the big money. that certainly has been the case with Bitcoin so far. Blockchain is creating a new demand for every corner of internet infrastructure. Security is still the big issue with theft a constant risk. And of course, we're looking at IBM, NASDAQ, and STX. A great play here is NASDAQ itself, the exchange. It's just dropped from 210 down to 160. We're targeting 300 by the end of the year. This is a way of buying shares in the casino. Massive volume increases are coming in NASDAQ shares in the future. And of course, they charge fees on everything that moves on the exchange. Share buybacks are another tech supercharger. $1 trillion has to be spent in buybacks by the end of this year. Almost all share buybacks ceased during the pandemic, except in big tech, where they're moving full speed ahead. Technology companies are spinning off profits so fast they are creating massive cash balances. Most prefer organic growth, so money isn't spent on takeovers. Dividend demands of a low interest rate world are minimal. 75% of all share buybacks take place in tech. When the supply of shares falls, the price can only go up. And of course, the biggest buyers of their own shares are Apple, of course, Microsoft, Micron Technology, and Intel. Apple, of course, stock that everybody follows, broke the 200-day moving average on Monday, came roaring back yesterday. We're at 155. We're targeting $200 a share for Apple by the end of 2022. CrowdStrike, another cutting-edge cybersecurity company. We are after a sell-off from 300 down to 150, exactly half. We're looking to buy here, and we're targeting a return to 300 by the end of the year. So with the blistering earnings growth rate at the end of COVID-19 coming, it's just a matter of time before technology stocks break out to new all-time highs again. Watch this space melt up big time going into 2023. Get ready to start reeling in those whoppers with the Mad Hedge technology letter as your guide. We have a proven track record of delivering blockbuster technology trade recommendations, in-depth research reports on the target companies and industries follow shortly. Get in on the early stage of every big trend. Let a 50-year technology veteran translate his experience into winning trades for you. Here's our secret weapon, the Mad Hedge Market Timing Index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms have become so dominant in the market, you should never trade without one. Ours took a team of mathematicians 1,000 hours to create. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. Don't go to a gunfight with a knife. If you are trading against algos alone, you will lose. Algorithms provide you with a defined systematic trading discipline that will enhance your trading profits. This is 3 years of buy and sell indicators from our market timing index. And you see we get lots of buys at market bottoms, lots of sells at market tops, buy, sell, buy, sell. It's like owning a printing press for $100 bills. Here's how it works. Our algorithm identified a potential breakout in Micron technology. So what do? We send out a trade alert to your inbox by email or text message. It says buy Micron technology at 4201 or best. And to get a $10,000 exposure, you needed to buy 238 shares. What did Micron do? It broke out to the upside, generated a 15.63% profit in 15 trading days. So what did we do? We sent out another trade alert saying take profits, sell Micron technology at 48.58 or best. and the profit on this trade was $1,563 in just 15 trading days. So this is the Mad Hedge Technology Letter Hall of Fame. This is a history of our 10 baggers. Zoom Technology, we recommended, went up 10 times on video conferencing. Lam Research went up 10.6 times. Moderna, we bought pre-pandemic, went up 12 times, and eventually ended up going 60 times from our original purchase. Nvidia, another one of our favorites, also up 50 times from our original buy in 2016. Square, up 25 times from our entry point. Again, another huge winner. And of course, the granddaddy of them all, Tesla, went up 400 times from our initial split-adjusted $3.30 purchase price. And of course, Tesla has global electric vehicle dominance, autonomous driving, solar panels, a huge electric utility, satellite, Wi-Fi. The rocket company, SpaceX, is in a separate company. You buy Tesla, you get the stock for free. I've actually had 3 of them. This is my Tesla Model X High Performance. Cost $162,000, fully tricked out with the ludicrous mode. Warning, when you go from 0 to 60 in 2.9 seconds, I'm all right because I'm a combat pilot. Passengers, not so much. So maybe a good idea to bring some extra air sick bags or a couple of towels for those passengers with queasy stomachs. This is my first Tesla. Was doing great until I got rear-ended by a GM Silverado pickup truck and a drunk driver. Of course, I used the opportunity to completely take the car to pieces. You can see here, there's the 1,100-pound lithium-ion battery under the back seat, carbon fiber wheel wells. In 5 years, the whole car will be made out of carbon fiber, giving you 10 times the strength at 1/10 the weight. So we're offering the Mad Hedge Technology Letter, the one sector you absolutely must follow on a daily basis. It's a 3 times a week read of the most important developments in technology, giving you the best stock plays. Includes a time-sensitive trade alert service sent out at market sweet spots, about 150 to 200 a year. Research by dedicated technology analysts based in Silicon Valley will send you immediately actionable trading and investment ideas on every important stock and subsector in technology. Finally, the detailed understanding of technology you've long been searching for. You need a real pro to guide you through the technology maze. Not all tech is monolithic. There are both great tech stocks and awful ones. You can earn a 10 times return on the great ones, but get wiped out by the lemons. A lot of tech stocks go public right when earnings are peaking and their business models are about to die, or at the very least become boring. Why you need me to stay up to date? You could copy the ticker symbols from this webinar and probably do okay for a few weeks. However, technology investing can be notoriously volatile, as a lot of these charts have shown you. Today's darling can be tomorrow's goat. Just giving you today's popular names is like handing you a book of matches in a gasoline refinery. Let me keep you current on the latest earnings reports and developments. That's the best way to max out your profits. So with the Mad Hedge Technology Letter, you get 3 times weekly the Mad Hedge Technology Letter sent to your inbox. You get the Mad Hedge Hot Tips 5 days a week, the 5 most important things that happened today and what to do about them. You also get access to the Mad Hedge Technology Leap service. Leaps are long-term equity anticipation securities. They minimize your risk while maximizing your profits. They are an ideal strategy for high-growth companies, give you a very low risk with a very high return, are only issued when the highest growth, best quality companies reach extreme oversold conditions like right now. This is where the big money is made in tech. And I'll give you an example of how our Tesla call options did. We bought the January 2023 Tesla calls, $130 calls, when Tesla shares were trading at 100 in 2020. The break-even point was 140. You know, that's a strike price of 130 plus $10 for the cost of the option. And that required a move up of 40% in 2 years to break even. Tesla shares then rose to $900, and after that to $1,250. The net profit was 900 minus 140 cost, 760, or a 76 times profit, or 7,600% in a matter of months. With high growth companies, a 30% gain is no problem, and a 2-year expiration makes it a complete no-brainer. You only need 1 out of 10 of these to work. In reality, almost all of our LEAP recommendations have been huge winners. Here is our actual trailing 1-year return for our Trade Alert service, 84.73%. And that's with the Dow down 7% so far this year. And if you think we were just lucky in the last year, we actually have averaged 44.91% return in the last 15 years. That is 2.23 times the S&P 500. And we've done especially good this year with our performance going straight up while the Dow went straight down. So this is what I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my major hedge fund clients for advice on the tech sector. And they're happy to pay it because I make them millions of dollars. And I'm not going to charge you $10,000. That's what I charge my concierge clients for personal one-on-one counseling who get my personal cell number. And I'm not going to charge you $2,500. That's the regular price on my website for the Mad Hedge Technology Letter. Today, and only through this webinar, creating a service cost me millions of dollars. With the best customer service in the industry running it costs millions more. Today, and only through this webinar, you can get 6 months for just $998. This is for new subscribers only. It's a one-time only 60% discount from the website price. Just click on the chat box on the right. That'll take you to my dedicated sales page where you can take advantage of this offer. With your subscription, you will get a 3 times weekly newsletter highlighting the most important developments in tech, immediately actionable text and email trade alerts and out-of-market sweet spots, live coaching through a bi-weekly strategy webinar and interactive Q&A, same-day answers to emailed questions about specific tech companies, special reports on dominant trends and players in tech, and access to a 14-year database. Gaining an unfair advantage in the most important investment theme of your lifetime will be the best decision you have ever made. So here's the offer you can't refuse. Let me show you how to make the money to pay for your own subscription. Just click on the chat box on the right. Buy now, and you will instantly receive a technology trade alert with an extremely high probability of success that you can execute immediately and make some of the most serious money in your life. Don't leave money on the table. 95% of these trade alerts make money immediately. This is the chart of the trade alert that we will send you immediately upon purchase of our service. You have to go through 1,000 charts to find one this good. Let me do the heavy lifting for you. We only take 25 new subscribers at a time, so it's first come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. So it's time to go flying again. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. So it was in that spirit that I made my way down to the famed beachside community of Malibu to meet long-term Mad Hedge follower Richard Zeiler. Richard is a man after my own heart, plowing his millions in trading profits into a ground-up restoration of a 1929 Travelair D4D biplane. This particular plane is quite famous because it was featured in a 1930 war movie, Hell's Angels, which won one of the first Academy Awards. However, Richard had to buy another 20 Travelairs to get the parts he needed to return this one plane to flying condition. The modernized plane has a 300 horsepower engine, carries 62 gallons of fuel, and can fly 550 miles in 5 hours. Since I'm one of the few living tailwheel qualified pilots left in America, Richard is happy to let me have the plane for an afternoon where me and my kids buzz the surfers and RVs on the California coast. Let me make millions of dollars for you as well as I have done for thousands of other followers over the last 15 years. I look forward to working with all of you. And here's the plane I just flew in the 1929 movie. And here is another plane with a film camera bolted on the back of it from Fox movie theaters making the movie. It was a fascinating experience, and it's always fun to participate in a piece of history. So here's the offer you can't refuse, just 6 months for just $998, new subscribers only. Just click on the chat box on the right.